Hello, good day. In this video, we are going to discuss money. Now, we proceed with the definition of money. So, what is money? Money is an item or commodity that is generally accepted as a means of payment for goods and services, or for a payment of debt, and that serves as an asset to its holder. Basically, without money, you cannot buy the things that you need and want, such as foods, clothes, shelter, and let us also add your personal bucket list, like cars and travel bookings. Money is composed of the bills and coins which have been printed or minted by the national government. In the Philippines, Bangko Sentral ng Pilipinas has the exclusive power and authority to issue coins and notes for circulation. Now, let us proceed with the properties that money must meet. So what are those? First, we have fungibility. Fungibility refers to being something, such as money or a commodity, of such a nature that one part or quantity may be replaced by another, equal part or quantity, in paying a debt or settling an account. Fungibility refers to being interchangeable with each other. For example, golds are not perfectly fungible because of their varying sizes and cuts. Unlike with Philippine peso, it is perfectly fungible because 1,000 pesos is interchangeable with 2 pieces of 500 pesos or 10 pieces of 100 pesos. Second, we have portability. Portability refers that money should be divided into small quantities so that consumers can carry different quantities of the commodity with ease. The purpose of portability is convenience. Imagine carrying 100 pieces of 1 peso coins in your pocket, when in fact, you can only carry 1 piece of 100 peso bill. Third, we have recognizable. Recognizable refers that the money should be easily identifiable so the consumers agree on its authenticity and quantity. Example, here in the Philippines, when you see a green peso bill, without any thought, you recognize it as 1,000 peso bill. Fourth, money must be uniform. Uniformity refers that every bill and coins of the same value needs to look the same. In this sense, a 500 peso bill and another 500 peso bill have the capability to buy the same thing. In addition, it has the same physical appearance. Lastly, money must be durable. Durability refers to the ability of this commodity to exist for a long period of time without significant deterioration in quality or value. In this case, money should be durable enough in order to withstand repeated usage and retain its usefulness for use in future transactions by the consumers. Now, let us move on to the functions of money. So the following are the main functions of money. First, it is the medium of exchange. This is technically the primary function of money, which is to be a medium of exchange. It means that money serves as an intermediary instrument in the acquisition of goods and services. For example, you want to buy a luxury shoes. Of course, you will pay that luxury shoes in the form of money. Second, it is the store of value. For money to serve as a store of value, when it is recovered, it ought to be stored for later use and utilized as a medium of trade. In short, the money is being stored for future purposes. That is why some people have emergency funds, savings account, travel fund, retirement fund. Third, unit of account. Money is employed as a unit of account in the market to determine the actual value of specific goods and/or services. In addition, money can be used to record the wealth possessed, spent personally or spent nationally. Example, every year, data is released showing the top 10 richest people in the Philippines. So tell me, how did they get that information? It is, of course, due to their monetary accumulation of wealth. The monetary value is measured by money. Lastly, it is standard of deferred payment. A standard of deferred payment is one of the accepted methods of settling debts. Since the money is accepted as a medium of exchange and serves as a useful store of value, the money can be used to transfer value over different time periods in the form of credits and debts. For example, ABC Corporation can borrow a quantity of money from XYZ Corporation for an agreed-upon period of time. Then, ABC Corporation can repay the money borrowed at a different agreed-upon quantity of money at a future date. For example, it can be in 12 installments. It can also be in 6 installments, and other terms as agreed upon by the parties. Now, let us proceed to the payment systems. Payment or settlement systems are mechanisms established to facilitate the clearing and settlement of monetary and other financial transactions. Basically, the payment systems has evolved over time from commodity money to fiat money to electronic funds transfers. The commodity money refers to good used as money that has value independent of its use as money. Examples of commodity money are gold, silver, and bronze coins. These were valuable because they could be used in exchange for other goods or services, but also because these itself was valued and had other uses. On the other hand, fiat money refers to money, such as paper currency that has no value apart from its use as money. Some examples of fiat money are the Philippine peso, United States dollar, European dollar, or Japanese yen. Today, we have digital currency. Digital currency is any type of currency that is managed, stored, and exchanged on digital computer systems, especially online. The Bangko Sentral ng Pilipinas has listed what it believes to be the 5 most desirable outcomes for a payment systems. First, we have security. Second, we have efficiency. Third, we have speed. Fourth, we have smooth international transactions. Lastly, we have effective collaboration among participants in the system. Now, let us proceed to the supply and demand for money. We have to remember that money facilitates the flow of resources in the circular model of macroeconomy. Macroeconomics is the branch of economics studying the overall economy on a large scale. It includes the studying of inflation, price levels, economic growth, national income, gross domestic product, GDP, and unemployment numbers. Basically, shortage of money will slow down the economy. On the other hand, surplus of money can cause inflation because of higher price levels. Now, let us proceed to the money supply. The narrowest measure of the money supply is M1. It includes currency in circulation held by the non-bank public, traveler's check, demand deposits, and other checkable deposits. M1 refers primarily to money used as a medium of exchange. In addition to M1, we have M2. This measure includes savings deposits and other short-term money market assets. M2 refers primarily to money used as a store of value. In addition to M2, we have M3. This measure includes financial institutions. M3 refers primarily to money used as a unit of account. Lastly, in addition to M3, we have L. This measure includes liquid and near liquid assets. Examples are the following: high-grade commercial paper and bank acceptance notes. Now, what is demand for money? The demand for money is the total amount of money that everyone in the economy wants to hold. The demand for money is affected by income levels, interest rates, inflation, and future uncertainty. There are 3 motives for demanding money. These are the transactions, the precautionary, and the speculative. When we say transaction demand, it is because individuals in the economy need money in order to cover their expenses and finance their discretionary spending. This kind of demand varies with the gross domestic product, and it does not depend on the rate of interest. Gross domestic product is the monetary value of all finished goods and services made within a country during a specific period. Second demand is the precautionary demand. Precautionary demand is based on unexpected need or unanticipated payments. This kind of demand varies with the gross domestic product. Last demand is the speculative demand. In this scenario, the money is demanded because of expectations about interest rates in the future. It can be increased or decreased. The money here is held to take advantage of speculative opportunities or for covering risks in other assets or the economy. This kind of demand has a negative relationship with the interest rate. Now, let us proceed to the quantity theory of money. According to the quantity theory of money, the general price level of goods and services is proportional to the money supply in an economy. The formula for the quantity theory is called the Fisher equation because it was developed by American economist Irving Fisher. In its simplest form, it looks like this. It is M multiplied by V, which is equals to P multiply Y. M means quantity of money, then V means velocity of money. This indicates the number of times money changes hands during a year to purchase goods and services. Then P means average price level. Lastly, Y means real gross domestic product. Or should we say the volume of transactions of goods and services? The formula states that the economy's nominal gross domestic product, or expenditures, which are P multiplied by Y, then it is equals to the money actually used in the economy, which are M multiplied by V. That is the end of this video. Please do not forget to like and subscribe in this channel. Happy learning!